morning. I'm Lisa Vatsky. I'm the Director of Multifamily Housing and Community Facilities with the Washington State Housing Finance Commission. And we're here today to talk about bonds and the 4% tax credit program. I'm very excited to have with us today one of our personal local celebrities, Thomas Stagg of Novogradac. And I can't thank Thomas enough for all his ongoing support and insight and Novogradac's work in this field. And so we're really excited to have Thomas talk to us today about bonds. And then Brian Coffey, who is a senior director at Synovus Bank, but we have him here today with his hat on as president of the Affordable Housing Investors Council. So really excited to have some national perspective as we talk about bond cap, as well as the local perspective. And I just want to say for folks, you know, the bond 4% program in Washington State has been highly competitive these last couple of years. We've just done some really amazing pivotal work with changing our bond policies and reframing and grounding us in some specific outcomes and values that we want to achieve with this program. We're really excited about some of the initiatives at the federal level. And at the same time, I've been hearing in the last few days some disappointing news about where we may end up with all those initiatives, given some of the reconciliation negotiations. But hopefully this session we'll be able to talk about what are the implications for all the things that are going on, and specifically celebrating the 4% fix, and then considering some outcomes if in fact we are able to achieve a lowering of the 50% test. So without further ado, let me turn this over to Thomas and have him walk us through some of the dynamics in the bond program.
Yeah, great. Thanks, Lisa. So we're going to talk about some bond basics to lay the groundwork here. Don't worry, it's not going to be all boring presentation, just this first little bit to lay the groundwork as I share my screen here. But as we know with bonds, let's see, I'm not seeing it pop up showing sharing. There we go. All right. So bonds, we love bonds. Washington State uses more bonds per capita than probably, well, for affordable housing than just about any other state. And we do a great job of using for affordable housing, but we have to understand that we like bonds for a couple of reasons. Number one, bonds allow us to access 4% tax credits. So we need these bonds in order to tap into this tax credit market so we can get the lower interest rate on the bonds, as well as the tax credit equity to fund our project. But unfortunately, bond cap is limited. You get $105 per person in your state. So Washington State, we end up with about 790, well, let's just call it $800 million of bonds. But these bonds have to fund various things. It's not just affordable housing, right? We fund exempt facilities, we fund housing, we fund student loans. And Washington State, you can see from this allocation, 33% goes to housing, but another 8.4% goes to housing authorities who are also doing housing. And so about 41% or 42% here of bonds go towards housing in Washington State, which is great. That's a high percentage. And the other thing is, when these other buckets don't use all their bonds, the commission, or the Department of Commerce, I should say, does a great job of giving them back to the commission to use for housing. And so we get this large pot of bonds, right? About $268 million. But the bonds are used to fund affordable housing, right? And so I often get this question is, you know, we've been doing this bond housing forever. Why is it suddenly competitive? And I prepared this chart on the right here because I thought it was really fascinating. It tells a pretty good story about why for a few years there, we didn't have any issues with bond cap. And now we suddenly have issues with bond cap every year. And the reason why it's kind of twofold is bond cap gets carried forward. And so during the recession years of 2008 through 2012, we weren't really using a lot of bond cap. And so we were carrying this forward. And you see, we had this huge carry forward. But then in 2014, we started really using the bonds. And you can see we've chewed through that carry forward. And now we have you see out here in 2020, it looks like maybe there's a little bit carry forward. That's just a little bit that didn't get allocated in one year that gets allocated in the next year just because of timing. But all the bonds are spoken for and then some in Washington State. We're so competitive. And a couple of reasons caused this shift. Obviously, the recession ending and an economy kicking up helped. Low interest rates have helped make these bond projects feasible. Living in an awesome state like Washington State, where we have legislators who are giving money to affordable housing, makes these deals possible. So we have all these kind of tailwinds pushing us to make these bond deals possible. But the problem is that makes it so that we're uber competitive. There's not a lot of bonds to go around right now. And so in order to access these bonds, we have to be able to pass what's called the 50% test. Whoops, I clicked one too many here. Let's go back. We have to pass what's called the 50% test. And the 50% test means that our project has to be financed with bonds, and that bond financing has to equal 50% of what we call aggregate basis, which is basically the cost to build the project plus land. So land is included in aggregate basis. And so this 50% test, we have a $10 million project here. Well, it's really an $11 million project. We're saying some of these project costs are not included in aggregate basis. So we ended up with 10 million aggregate basis. So you have to spend at least $5 million of bonds on this project to meet the 50% test. Now, what happens if you don't meet that 50% test? It's catastrophic. You end up only being able to take credits on the amount financed by tax-exempt bonds. So this example, we're saying you barely failed the 50% test. You're at 49.99999%. And so instead of receiving $4 million of equity if you pass the of credits, if you pass the 50% test, you end up only receiving $2 million of credits, which obviously makes your project suddenly have a $2 million gap here because you're not receiving the equity from those credits. And it likely makes your project fairly infeasible. So the 50% test is something we don't want to mess around with, because if you fail it, you lose a great deal of equity. And so it's really not an option. And so because of that, we often end up, I'll come back to what we do because of that. But we see here, as I talked about, these bonds are in such high demand that of these states, and this is prepared by our good friends Tibber Hudson, who's a bond counsel, went out and surveyed all the states and are tracking this. It shows that in 17 states, we're oversubscribed, meaning more people are requesting bonds than are available. And in 9 states, they're kind of right there at parity, where every year they're allocating all their bonds, but they don't have this huge backlog of additional projects asking for bonds. And then about half the country, 24 states, are still undersubscribed. And when you talk to these states, some of these states are just undersubscribed because of the economics of their state. They don't have all this additional state funding we have to make these deals feasible. They have fairly low income limits, so low rent limits to fund the debt service. So these deals are maybe not as feasible there. So they're not using all their bond cap. And we have another subset of these that are pretty close to using all their bond cap and likely will start to be oversubscribed in the next few years. So bond cap is definitely this scarce resource right now. And so there's this provision, that talks about reducing this 50% test I just talked about down to a 25% test. So now instead of financing your project with 50% with bonds, you'd only have to finance 25% with bonds. Now you could always do more. So these states that are undersubscribed, where they say, no, our projects really need additional bond financing to make a deal feasible, they can allocate the same amount that they're allocating now. But in states like Washington or other oversubscribed states, they might decide to only allocate a lower percentage to each project to make it so that more projects can be done. So as part of the Ways and Means Reconciliation Bill, we went out and we looked at how much this would impact housing stock across the country. And we calculated that there'd be almost 1 million additional units created over 10 years due to lowering this 50% test to 25% test. A couple of notes here. Number one, it is only a temporary lowering of it for 2022 through 2028. And also, as maybe we'll talk about in a little bit more later, budget reconciliation, obviously it's being hotly debated right now, and we're not sure that this will go through. So I don't want you to go out and start underwriting deals at 25% right now because we said, oh, this is a slam dunk, this is going to happen. This is on the table to address the bond cap issue. And so how does this address the bond cap issue? It does it kind of through a back doorway, as opposed to kind of doubling the bond cap. It reduces the amount of bonds we need on each project. So as I talked about earlier, failing the 50% test is really not an option. You fail the 50% test, your project basically becomes infeasible. And so usually we underwrite projects to have a buffer. Usually we fund projects around 55%. That I think was the goal that Washington State was funding at this last year. And we see many states that are at parity are funding somewhere between 50 and 60% as the max amount of bonds that they're giving to any project. So if we lowered it to a 25% test, you'd still want that buffer, but interestingly enough, a 27.5% buffer is the same as a 50% buffer, meaning that in both cases, you could have $1 million increase in your aggregate basis, or as we commonly call it, $1 million of cost overruns, and you still be able to pass the 50% test. So that 55% buffer you're used to would, a 27.5% buffer would give you the same amount of overall cushion on your 50% test. But what that means, kind of big picture, is that, using this very simple math here, right? $55 million of bonds could fund 10 $10 million projects under the current 55% regime. But if we change that to the 25% test and funded it at 27.5%, that same $55 million of bonds could fund 20 $10 million projects. So kind of keeping, there's a lot of kind of nuances here, but keeping it all equal, it theoretically doubles the amount of bond projects that could get done. Now, of course, bonds have a lower interest rate, so losing the bonds on a project will make it so you have to fill that gap somewhere else, and there's other things to consider. So it's probably not going to be exactly double, but it does serve to increase the amount of projects that can get done. And the reason why, I get this question a lot, saying, well, why don't we just double the bond cap? Well, doubling the bond cap, sure, it'd get us to this same spot, but as we said, that bond cap is used for a lot of other projects. And doubling the bond cap is at direct cost, that when you try and say, oh, we're going to double the bond cap to $210 per capita in a state, that's a lot of money for scoring and budgeting. And so this is kind of a roundabout way of increasing bond cap to cap constrained states without really having as big of a financial impact. And that was the end of kind of my canned material here on the overview of the 50% test, the reason why we're in this bond cap scarcity, and talking a little bit about the 25% test provision. So Lisa, I'll turn it back to you.
Great, thank you, Thomas. And please use the chat for any questions. We'll let Brian share some of his insights from the investor side, but we're happy to take questions at the end, towards the end of the session. So thanks, Thomas, really helpful to show. I love all those extra houses that you had there. That was a nice visual. All right, Brian, take it away.
Yeah, once again, I'm Brian Coffey. I'm officer with the Affordable Housing Investors Council. And Lisa, can you see the screen?
I can, yes, thank you.
Okay, thank you. Our trade group is comprised really of the largest banks and insurance companies and a few Fortune 500 companies. And we're all active investors in the low housing income tax credit program. The trade group has been in existence for over 20 years, and our mission really is to promulgate best practices and frankly bring a level of transparency and integrity to the industry. We all have a very strong vested interest in making sure these projects not only built, but that they're managed appropriately over their 15-year compliance period. Just to give you a little background on the trade group itself, you hear a lot about CRA, and admittedly, many of our investors are CRA oriented. For those of you who don't know, there is a federal regulation that requires banks to have some level of investments in their communities. Low-income housing is viewed as a very safe and effective way of meeting that investment test. So that's why you see many banks in this industry. Frankly, over the years, the banks have really dominated this landscape. And in the past, you may have seen some utilities or even oil and gas companies in the industry, but banks really probably command maybe 90% of the overall industry today. Hopefully, that as time goes on, that will change. I think some of you may have read that Fannie Mae and Freddie Mac are back in the industry, and now we're allowed to have a bigger share. just to sort of give you a context, the overall industry is viewed at roughly $16 billion a year, and Fannie and Freddie now are allowed each $850 million of the equity market. So they will not be the commanding force that maybe they were back in 2005 and 6, but a nice presence. Just to sort of give you some other thoughts, on the industry itself, the industry is still fragmented, which I think is a good thing. You just don't see any major banks dominate. I think probably the biggest market share of any individual investor is maybe 10 or 15% of the market. Also, you are seeing an interesting trend in industry where you're seeing combined debt and equity platforms. And I think it's a trend that's going to continue, where you may have a big bank provide both the construction, permanent loan, and the equity investment. Just to give you some ideas, some market trends that we're seeing. And once again, I'm bringing a perspective of a sort of a national view. I'm located here in the Southeast, so I'm certainly going to have a few more sort of anecdotes and stories to share from the Southeast, but I do participate actively in AHIC and certainly can provide some details on what we might see in other markets, whether it be New York, Florida, Texas, or even California. I would say, as a general rule, CRA yields in CRA markets are still holding steady, but I would say in other markets, you're seeing yields drop and yields rise, and with that pricing drop. So we've seen roughly a 5-cent drop in pricing from 18 months ago, and you can ascribe some of that to the pandemic, but really more so to increase in supply of tax credits. Once again, it's interesting as we see a little bit more supply. I think investor parameters are changing a little bit. We have seen over the years many mixed use or mixed income properties, particularly in markets like New York, and I think investor appetite is less robust for those in years past. Also, frankly, we're very anxious to see income averaging be embraced by the industry. Just sort of as a side note to the group, there was a conference call with Internal Revenue back, I think, Thomas, back in April or May, and Internal Revenue has taken some pretty harsh stances on income averaging and have some standards that would result in the potential loss of credits that we call a cliff event, and it's really put a chilling effect on this public policy. And I think it's very important as we look around the landscape, we see a lot of bond deals underwritten as assuming all tenants are at the 60% income level. Really would like to see income averaging utilized, and hopefully Internal Revenue will come off their stance and allow a more pragmatic approach should you have some kind of tenant violation and you rent over income tenants. So I just want to share that. That's something I know our trade group and Novogradac have been really pushing Internal Revenue to offer some more lenient standards so we can see the widespread incorporation of income averaging. And with that, the idea is you wouldn't need to really rely on mixed income as often as you have in the past. I make a sort of an interesting comment here I've shared with people. What I'm seeing in some industries is that the LIHTC industry is competing against other energy credits, notably solar. And I know solar is a 1-year credit, LIHTC is 10, but there are some circumstances I could point to, particularly with non-banks that they're migrating to solar, and particularly with the Biden administration, you may see a whole sort of fruit basket of new credits out there that may in some ways diminish the overall appetite for LIHTC. I hate to speculate too much, but that's certainly one of the adverse consequences we were thinking aloud about. And then, but I would say in the same breath, LIHTC itself is the markets and the properties themselves are just doing phenomenally. We're seeing all-time record rents, record occupancies, and even the pandemic, most properties came through really in very strong shape. So it's sort of an affirmation of the underwriting and sort of the great property management we have, and I just hopefully that will continue in the foreseeable future. Then lastly, I just want to share a little bit about sort of the impact of the flat 4% rate. I think that was a huge win for the industry. And I think with it, you know, as I alluded to earlier, you're seeing an increase in supply of tax credit deals, maybe not so much in Washington, but certainly in other states. Just to sort of share with you, in Iowa, there hadn't been a single bond deal done since 2018, and now you're starting to see a few. Where I live here in Alabama, and yes, you can make any football comments you want to make. I'm a University of Alabama alumni. To give you an example, there was 3 bond deals done the last 2 years. There's now 24 under application here in Alabama, and that was sort of going back to the slide that Thomas put together of underutilization. That you have some states that didn't have state level subsidies, that now all of a sudden the deals that didn't work before with that extra equity are working. So it's good news for Alabama residents and Iowa residents, but it is sort of increasing the overall supply. It's going to be interesting to see what happens. Like New York, there was such incredible state level subsidies. I think with more equity, they simply may just reduce the state subsidies. Florida is really an interesting example. Once again, going back to Thomas's point, 25% of their bond allocations is allocated to affordable housing. And of course, as he mentioned, in some cases, if other areas don't use their bonds, it gets moved over to affordable housing. But what the situation there is a little bit more bleak, and the state actually had set aside through a congressional mandate that all mortgage taxes would go toward affordable housing, and yet year after year, the legislature in there pretty much raids that kitty of money. It's a $600 billion annual subsidy that gets cut at least in half every year by the state legislature. So it's interesting seeing different states, how they support or don't support affordable housing. Like in Texas, many cases they abate or outright waive the property taxes, and that's a very significant subsidy, but that has a potential to go away in the year of a recession. And then, I mentioned another example of Tennessee. You'll find this interesting. Their subsidy is in the form of they allow developers a 25% developer fee. So it's ironic that really has helped in their markets. And that's one of the states that Thomas showed as being oversubscribed. The developers are eternal optimists, and they think they can get that fee. And the state agency draws a firm line. They can only earn 15% by CO, and the other 10% has to be deferred. But nonetheless, it drives a lot of bond demand in that state. So, a couple other comments to sort of share. We are seeing, like example, South Carolina now has a state low-income housing tax credit, and the state agency is absolutely overwhelmed. So we would sort of surmise in some states they really need to change the staffing in their state agencies to handle this increased volume. And then lastly, I sort of openly worry that there's not enough investor demand to really soak up the excess supply that's being generated. And once again, I don't have any definitive numbers right now, but the sense is the market's going to increase by probably 20-25% with a flat 4%. So anyway, I just want to sort of offer a view from the investor standpoint. I have to say, for you residents there in Washington, you're so lucky. You have a supportive state government. You have a great agency. Your deals work, and you get a lot of support. That's really not the case in many other states. And I just think it's great that there's so much support in your state. So anyway, I'll pause here for any questions or comments.
So Brian, all I would say is that the commission, the Washington State Housing Finance Commission, is to low-income housing tax credits what Alabama is to college football. We're a powerhouse to be reckoned with, and we use every tool at our disposal to be the best that we can be. And so I envy Alabama's success, but I'm glad that we have that success on the housing front here.
Yeah.
So I did have a couple of interesting, so looking at your slides, Brian, those are great. It was interesting. I think it really is important to hammer home to people how much the credit market has increased recently, right? So with the 4% floor, which is now really, this will be the first full year where all projects have the 4% floor, all new projects. So we still haven't seen this full increase in credits because of it. And we're already feeling some impact on credit pricing because, as you said, it's about a 30% increase in equity across each project. And on top of that, it makes more 4% floor, 4% projects feasible. So it's not just a 30% increase, it's another, 20% of projects are getting done. So maybe it's closer to a 50% increase in the amount of credits that are out there, maybe even more. I don't know. I haven't ran the numbers. And so that is putting a big strain on investor appetite. There's just more deals out there to get done. And so investors can be more choosy. They can demand a little better yield. Obviously, tax rates haven't helped on the yield side with those going down. And so I do think that that is a concern. And then with the 25% test, right? If we now double the amount of 4% projects that already were 30% increase, now we're looking at, maybe a doubling of the amount of credits that are out there. And, as an accountant, I can tell you that not everybody can use these credits. They're really made for, large financial institutions to use. I can't use them as an individual. They get capped pretty quickly. And so we do worry a little bit about, with tax rates where they are, about investor appetite. And I just think it's an interesting discussion about, what would you rather have, credit pricing at $1.10 and a scarcity of resources, or credit pricing at 80 cents and every deal gets done? I often say, just tell me what the credit price is going to be and we can figure out how to get it done. Where the industry struggles is when credit prices shifts quickly in a short amount of time, because a $1.05 project looks different than an 80-cent project, but we can get both done. It just takes more planning to get the 80-cent project done.
Yeah, really important impacts potentially if we are able to get the federal initiatives passed. How is that going to impact the appetite in the market? And yeah, do we need to attract more investors or how does CRA play into that? And I don't, so thinking too about all of these variables and how it impacts the market, and then how much time does it take the market to respond? So playing off that, I don't know, Brian, if you have additional thoughts on kind of the whole.
Yeah, there is one positive note, I guess. The OCC, which is a big regulator really of the larger banks, had proposed that the investment test would go away. And that rule has now been overturned or sent back to square one. So CRA is still intact, and with a requirement that all banks still essentially have 25% of their overall CRA activities have to be in the form of investment. So that, I think that bodes well for the light tech industry.
Yeah, I think that's a great point. I think it's also, as we talk about, if we really do get in a place where supply is outstripping demand, it's important for all of us to be working with our smaller local community banks and educating them about the tax rate investment, how it helps with CRA, so that we can attract more investors. And especially, I love the fact when we have a community bank investing in a tax rate project in their backyard, it really, I think it's great. No offense, I love US Bank. I love the other big investors as well buying credits, but I think it's awesome when we can reach out to those smaller banks and get them involved in the industry.
So you touched on income averaging. Maybe it would be worth sharing a little bit more. I know both of you participated in the IRS hearing. And so maybe sharing a little bit about your insights there. And is there any word on how that's like, is IRS said anything about providing additional guidance? Or maybe you could expand a little bit on the income averaging conversation.
So Brian, I know you had, I can go first. You can go first.
Yeah, go ahead. You go first. Yeah.
Okay. Yeah, so income averaging, we thought was going to be this great tool, right, to help us reach down to these deeper targeted individuals, right? So income averaging allows you to still average 60% affordability across your project, but now you can reach up to people making up to 80% of area median income and down to people making 20. And the thought was that you would average across the project to 60%. So you'd, a very simple example, you'd have 5 units at 40%, 5 units at 80%. That would average 60%, and therefore you wouldn't need any additional subsidy to pay for those 40% units because you're paying for them with the 80% units in your project. Especially in a robust environment like Washington State, where we have people at all spectrums of the income threshold that need housing, we thought this would be a great tool in our tool belt to reach out to these additional households that were either underserved or really not served by our program at all. But unfortunately, IRS guidance came out with basically really, really poor guidance. And it all hangs on the fact that, let's see, is there anybody from the IRS on today? It all hangs on the fact that the IRS, that the people I think who wrote it really don't understand our program to begin with. And so their interpretations, I think, kind of missed a nuanced reading of the code that we're used to. But basically, as I said, we're supposed to average, right, 60% across our project. But how the IRS is interpreting is, instead of averaging 60% based on our designations, right? I told you we have 5 at 40, 5 at 80, that average is 60. They're saying you have to average 60 across your qualified units. So what happens if one of these 40% units goes out of compliance for any reason? It could be a full-time student that was moved in. It could be that you actually miscalculated income and that's really a 50% household. Whatever it may be, if you lose that 40% household, the IRS is going to look at your remaining, as I lose my fingers in my background here, the IRS is going to look at your remaining 9 units and say, oh, you now average 62.5%. And suddenly, even though you have 9 affordable units paying affordable rent, rented to affordable tenants, 4 of which are rented to tenants at 40%, the IRS says, well, you failed the minimum set-aside test, you lose all your credits. And now there's ways to mitigate this, et cetera, that the industry is responding to. I always joke that our industry is like cockroaches, that you can't kill us. You give us bad average income guidance, we figure out a way to make it work. We'll just keep coming back to try and build housing, but it makes it so it's not attractive to investors. And there's a few other provisions in there that are also kind of unfortunate, but to me, that's kind of the biggest one that's put the pause on this. And Brian and I both spoke to Treasury at their hearing. I've spoken with them at other events and National Council of State Housing Agency event. We talked about how I think it should be interpreted, et cetera. But right now, that's the proposed regulations from the IRS makes it so that average income is very kind of difficult to do. We're hopeful that the IRS is hearing us, that they're listening to what the industry is saying. And it's great because the industry is really pretty united in saying that this guidance doesn't work. And if you stick with this guidance, it's going to be almost a dead code section, that it won't be used very widely. But the IRS is very cagey. They keep their cards close to their vest and they don't let us know what they're thinking. And so why I do think that the IRS is going to acquiesce on some of their kind of strange interpretations, mainly the fact that you can't change designations. I think the IRS will acquiesce on some of those. We just don't know how far. And as we know with investors, as Brian could talk more about, if there's any bit of uncertainty, investors hate uncertainty. They buy these credits because they're a very stable, predictable investment, and therefore they can have a very low yield because they're very predictable. When you add this unpredictability in there, the investors say, look, I have other options. I'll go elsewhere. And so that's what we're kind of seeing right now. And maybe, Brian, you can talk more about that side of it.
Oh, no, yeah,
the
the idea is if you're making a $10 million equity investment and then you find out 2 years into the project, Internal Revenue has disallowed all your credits because of maybe a very simple clerical error or simple oversight of 1 unit, 2 units. You can't look to a developer that probably in most cases write a check to make you whole. And it's just a level of risk that we haven't seen in the past and never had to confront. And once again, I please our bank, and I think many AIC members would love to do this, and because there is a risk of oversupply. Like for instance, Austin, there must be 30, 40 bond deals that have either been built or being proposed in the metropolitan area. The income levels are very high, but every single bond deal I've seen there is underwritten assuming all the tenants are at 60% income levels, and you just reach a point of saturation. And really, from an underwriting standpoint, market standpoint, if you could have some at 80, some at 40, 30, and if you step back, it's those 80% tenants are really subsidizing the others. It's the developer's not making an extra penny. So the idea is that you really have a more equitable and a better project with a broader tenant base than what you had before.
Yeah, and as we talked about, 4% projects, we're so lucky up here in Washington State that a 4% deal just pencils. You can almost do what I call a naked 4%, where all you have is bonds, equity, and deferred fees, and it makes it work. That's not true in a lot of the country. And so being able to capture this higher rent, which allows you to capture maybe more occupancy, and you're not, as Brian said, you're still averaging 60%, but you're able to reach a bigger cross section of the market that maybe makes your deal more feasible. And so it was one more way in these states where they're undersubscribed to maybe get more projects done, more projects feasible. And so there's a lot of good reasons for this. And unfortunately, it's somewhat been kneecapped by the IRS, if you will.
Yeah, Lisa, you'll find this interesting that one of the highest income cities in the Southeast is Huntsville, Alabama. But you could never command the rents that you're able to charge under the AMI test because the market won't allow you. You won't get those rents. So on the flip side, Miami has surprisingly low incomes, and so it's very hard to underwrite because your rents are so low. But conversely, you're always going to rent those. That's just probably one of the safest investments you might find in this country. So.
Yeah. So average oh, go ahead.
No, go ahead. No, go ahead.
I didn't say average income helps in places like Huntsville where maybe you can't get higher rent, but you're probably turning away a lot of people who are making over 60%. And so average income really helps you capture that part of the market.
Yeah, that's a great second point. Yeah.
And then it does look like we've got a comment or question about if the project still averages to 60%, how does that drive the quote unquote naked 4% deal, as that income averaging doesn't support higher perm debt, really, does it? It kind of averages. So
yeah, so I think that's kind of the point, is this isn't some sort of cash grab that suddenly we're getting a lot higher rents. Although there are some ways with voucher tenants and things like that you can come out a little bit higher, but what it does is it just helps have a project that reaches a bigger cross section of the population. So we're not 100% at 60, we're spread throughout, and so we have a more robust population. We're reaching up to higher tenant levels, and so yeah, it's not going to make your deal more feasible from an income standpoint, maybe from occupancy like we talked about in some markets, but it just makes a project that's self-subsidizing itself to have some deeper targeting.
right.
So Lisa, I think that, we talked a little bit about the 50% test. I'm not sure if you want to jump to this, but we have people who are maybe struggling with the 50% test, and maybe we can talk a little bit about managing that cap if you want. I don't know if that was on your agenda or.
Sure. Yeah. I mean, one of the things I know that we've been doing, like you mentioned, we had been requiring projects to come in at 55% with some of the supply chain issues and cost issues. And maybe we can kind of dovetail into that conversation about what are we seeing nationally now about supply chain and cost issues. We have actually begun to look at lowering it to 53%. So again, needing to put in more bond cap for these deals, but trying to play with that cushion. And I know that's part of why we wanted you to show kind of what happens if you're below 50%. But it would be also helpful to hear, Brian, what kind of from the investor perspective, how much cushion is needed, and if that's a way that we can, again, kind of most cost effectively use bond cap. We're looking at, especially in this environment where we've seen so many deals come back to us and need more cap, trying to size it more at 53%. So any comments about costs and I guess cushion maybe Brian, you could also expand on kind of, you said, investors, what are the three most important things investors are looking for these days, I guess?
Well, it's interesting that, we've seen the last, of course, 9 months, incredible rise in construction costs. And I guess I've lived this firsthand, probably in Georgia, which was probably one among the more proactive state agencies in going back and giving people increase in their bond allocations and increases in their LIHTC allocations that cover these cost increases. Which was really the great solution, and I'm sure Tom can explain that, because you ultimately you can't cover the increases just with extra equity or extra subsidies, because you're going to bust through your 50% test. Is not intuitive. But what was ironic is you had some investors that have these different criteria about, I don't want to do a single deal over 25 million, or it's in the fund and no single project can be over 20% of the fund, or gee, I didn't want to do this in Metro Atlanta. And all of a sudden, even though the deals had more credits and the state agency was trying to help, people were starting to back away about, well, this is not what I signed up for. So it was sort of an interesting circumstance. And we saw that in a few cases. The developers have to sometimes just go scratch their heads, because the investors have some very hard and fast rules that I think were made up in the midnight bar somewhere, but nonetheless, they have this idea about concentration risk, and then they won't go through them or above them, and it just creates some problems, I think, and challenges in a very fluid environment like what we've seen in the last 9 months.
Yeah, and so, you know, I think when looking at that bond cap, right, I can tell you supply chain's not done having issues yet. As somebody who doing a kitchen remodel that ordered appliances in April that are not here yet, I feel this firsthand. I'm sure that people who are having 50% test issues don't really care about my appliances, but it hasn't fixed itself yet. And so the issue is we have these competing items, right? We want to manage our bond cap because every dollar we save giving to this project can give somewhere else.
Yeah.
We have this finite resource. But if we get too tight, then we're going to fail the 50% test. And so investors want a buffer. You know, I usually see on an initial application this preliminary 50% test. Investors don't like it below 55%. That's kind of that sweet spot where they feel some comfort, because the 55% test, because it's a 50% test, you kind of double that cushion. So it gives you 10% cost overruns. And that's why on my earlier slides, we had a $10 million project. You could have a $1 million cost overrun. So you push that down to 3%, 53%, right? Now you only have a 6% cushion. So on a $10 million project, that's only $600,000 cost overruns. That's one environmental inspector having a bad day, and suddenly you failed the 50% test, right? And so that buffer becomes important. And so what we want to do is think about upfront ways that we can pull items out of aggregate basis. And kind of the number one thing I'm seeing right now is we are trying to, as much as we can, pull land out of our project, because land goes to that aggregate basis, but it's a bad cost in the sense it doesn't generate tax credits. So it's in our aggregate basis, making us pull down more bonds, but we're not getting any credits for it. So that's the number one thing I'm seeing right now is we're trying to do some sort of operating lease for that land. And so the land is not pulled into aggregate basis. That's kind of cap management number one. Number two is, to the extent that you have commercial space on your project, you're trying, in commercial space, again, similar to land, it's in aggregate basis, but you don't earn credits. So we're trying to pull that commercial cost out into a different project as well, so that we're pulling that out of aggregate basis. And those are our two biggest tools up front. But then once we get into a project and you start spending these costs, there's not a lot we can do to reduce aggregate basis. Sure, we can get, you know, especially on AC rehab, we can get a little creative on what we're capitalizing, what we're expensing, but those aren't these huge levers. They're kind of small tweaks we can do to get you from, you know, 51% to 51.5% to maybe make an investor feel a little happier, but they're not something that's going to save you if you've had, you know, huge cost overruns. And so that's why it's important that, you know, we work with the state, and the more the state pushes that 50% test down, the more they have to be willing to work with us to the extent that you have cost overruns. And states, they're not going to give you a blank check and say, oh, if you have cost overruns, always come back. You're going to need to have a compelling story, and you don't want to be the outlier, right? So if everybody else is saying, yeah, I have 2% cost overrun, so I've covered, and then you come back and say, I had a 20% cost overrun, you know, Lisa's going to scratch her head and say, what's going on here, right? They're not just going to give you this extra bond cap because they still want to manage it. But I think that, you know, and not putting words in Lisa's mouth, I think that as a state pushes that down, they have to be aware that there are going to be a better chance somebody fails it and have to work with you. But that's the easiest way to fix it. And honestly, what your partnership agreement says, how you fix it, you start giving up developer fee. That's bucket number one we start pulling from. So if you have failed your 50% test by $500,000, we're going to reduce your developer fee by $500,000. So now you pass your 50% test because we've just pulled that out of aggregate basis. And that's going to hurt, especially if that was a cash paid developer fee. But that's going to be the first bucket that gets pulled from. And usually states, when they are giving you additional bond cap, they're going to want some sharing there that says, hey, if you're coming back for more, you got to share some of the pain. Or Georgia, like Brian said, what Georgia said is they have a strict cap on how much any one developer can receive in bonds. And the extra bonds you requested count against your cap. I think it was maybe for even 2 years. There's something special about
let's
how it counted. And so there's different ways that states are doing this, but, you know, we're a partner and we have a great state that listens to us, but that's kind of the issue we run into here, because they want to build as much housing as possible, because guess what? Behind your project, there's 100 projects waiting to get funded. I talked to, again, looking at this, we were kind of talking about, well, what happens if we get the 25% test, and let's ignore credit pricing issues and say we can do twice as many projects now? Do you think that means that Washington State would have excess bond cap? And Lisa just laughed at me. She was like, no. We have so many projects that could get funded, but for the bond cap, that we'd probably be at oversubscribed for this whole 8-year run of the 25% test. So that's why they're taking this so serious. They're not trying to be mean and really hound you on your budget. It's because for every dollar they give you, that's one less dollar we can put towards another project. And you add that across 20, 30 projects, that adds up. Anyways, I think I've gone off on too far of a tangent now. So
no, that's great. I mean, can we circle back though? Because I am seeing a couple of questions in the chat about kind of how to fill the gap of 25%. Like what becomes the new financing stack if it's down to 25%? Maybe you could share a little bit about what that might look like.
Yeah, and so it really depends on the type of the project, right? It was interesting. We did this survey in California, and we looked at construction financing on bonds and perm financing on bonds. And we saw in there, because they had so much public funds, that on average, every project had less than 25% bonds in their permanent stack. Now, when we did the same kind of survey in Washington State, it wasn't quite as severe. It didn't go down from this 60% at construction down to below 25% at conversion, but it still had a big pay down, right? So most of us aren't sitting there, or a lot of us, some of us are. Obviously, the naked ones are sitting there with this high bond amount, but a lot of the projects aren't. They're paying it down. So we already have some pay down contemplated. And I think the other thing is, we have other tools in our bucket. To a certain extent, we have some recycled bond cap. But again, as we start allocating only 55% to a project, and they're at conversion, they're only paying down to 45%, there's not a lot of recycled bond cap out there. That's going to diminish as we go forward in this tight environment. So recycled bond cap is a great resource, but I think we do a pretty good job of using that. The second is going to be taxable TEL. And thankfully, we don't have a huge gap in interest rates right now between a taxable bond and a tax-exempt bond. Theoretically, they should be trading at exactly 21% apart from each other, right? Because you're just saving the taxes, but that's not what they trade at. They're actually much closer than that. And when we're in such a low interest rate environment, that backfill is often going to be, number one, the increased equity to 4%, but then just some sort of conventional debt filling that gap, or more deferred developer fee. Yeah, I don't know, Lisa, if you guys have looked into this. Yeah.
Well, I think I think, thinking about taxable or recycled. Also, I'll put in a plug for the Evergreen Impact Housing Fund. We have been able to attract some philanthropy and corporate dollars. The credit unions actually have invested in this fund. And so, yeah, looking at either public gap financing or private gap financing or issuing taxable debt potentially. So we have a question about demand and supply. If demand is so big compared to supply, how can supply be increased? And is this mainly a federal decision to allocate more budget towards low-income housing tax credits?
So is that excess supply of housing or excess supply of credits? I wasn't sure.
Yeah, I'm assuming housing.
Yeah,
I'm sorry. You want to get that, Thomas? Go ahead.
Well, I don't know. I was going to say, well, I think I'll answer why we have more people trying to do deals than there's money for. And maybe you could talk about what happens if there's more credits than there are investors. Maybe we can bifurcate like that or not. But I'll talk first about, why do we have so many projects that can't get done? Simply because it's a limited resource, right? Our 9% credit is capped at what is it, $1.30 per person times 10, and our bonds are capped at $1.05 per person, and so, or $105 per person. And so we have this cap that we're using all of the resources available and giving them out. But unfortunately, tax credits are such this big engine in this, that you get this 40% equity in your project, that when you can't do when you try and do a project without tax credits, it becomes very hard for that deal to pencil. So we have these projects that can pencil if they're able to use these credits, but without these credits, they can't. And so we have this big backlog of people who are trying to either grab the 9% credits or grab the tax-exempt bond so they can access the 4% credits, but we're just limited. And that's why we're trying to be as wise as we can with these resources. But for the cap, I mean, Lisa, you'd probably do 6 times as many projects a year. What do you think, honestly?
Yeah, I mean, we're oversubscribed 4-1 at this point, and I do think, you know, folks are, with our changes in our bond policies and kind of the market, folks are, I think folks could easily do more, but are kind of waiting to see how things are going to play out now. So I think we do actually need to wrap up, but I want to just thank so much both Thomas and Brian for joining us today. Thank you all in the audience for joining us today. And I know, Thomas, you have another session later on today, so folks should join us. And then hopefully we'll hear more from Emily Kadick about the federal legislation at our noon presentation and keynote. So thank you both so much for joining us.
Thank you.
Thank you, Lisa.
Thank you all.